Bitcoin whales are making waves. One massive wallet just moved $17 billion worth after 14 years of silence. What does this mean for the market, and is it connected to the recent debt ceiling bill? Experts are debating the implications, but one thing's for sure, you don't want to miss this. In the latest video from Altcoin Daily, Aaron discusses the recent movement of Bitcoin from dormant wallets initially thought to be Satoshis. On-chain analysis suggests it's likely Roger Ver, an early Bitcoin advocate. Aaron also talks about upcoming crypto weeks in Congress focused on pro-crypto legislation. He mentions GG3, an AI-powered community management platform, now live on Max. Its token, GGX, is gaining traction. Finally, he touches upon Circle, a stablecoin company running on Ethereum, recently going public with a surging stock price. He sees this as positive for Ethereum's future. I find it interesting how Roger Ver's Bitcoin move overshadowed other significant news like Crypto Week and Circle's IPO. It shows how much weight individual actions still carry in the crypto space. Although the initial panic subsided, such events remind us how volatile the market can be. The connection to Mt. Gox also raises eyebrows, recalling past controversies. It underlines the need for transparency and due diligence in this evolving landscape. While some may dismiss such incidents, they offer valuable lessons for navigating the crypto world. In the latest video from Crypto Rover, a large Bitcoin wallet, dormant for 14 years and holding 161,000 Bitcoin, around $17 billion, transferred its entire balance to a new address, causing a massive on-chain reaction. This event, combined with the recently signed bill by Donald Trump raising the debt ceiling by $5 trillion, leads to speculation of increased money printing, potentially boosting Bitcoin's price in the long run. Bitcoin's price is currently consolidating, with key resistance around $110,000. Crypto Rover points out similarities between the current market structure and the 2017 bull run, suggesting a potential breakout. He's bullish on Ethereum, highlighting the recent golden cross and a potential move towards the upper resistance level of the current range. This Bitcoin whale activity is definitely something to keep an eye on. It's a lot of money moving around, and while it hasn't directly impacted the price yet, large sell-offs could create downward pressure. Also, tying this event to the debt ceiling and predicting Bitcoin's price movement based on it seems a bit of a stretch. While increased money printing can devalue the dollar and potentially make Bitcoin more attractive, it's just one factor among many that influences its price. The crypto market is influenced by so many things, it's impossible to make definite predictions, but the situation creates room for an interesting time ahead in crypto market. In the latest video from Lark Davis, he discusses the correlation between the global M2 money supply and Bitcoin's price. He explains that as M2, cash, checking, and savings deposits increases, so does Bitcoin's price, typically with an 8 to 12-week delay. He cites analysts like CryptoCon who predict Bitcoin's rise until September 2025 based on the current M2 trend. Lark also mentions other factors influencing Bitcoin's price, like institutional investment from companies like BlackRock and Fidelity, as well as the increasing number of companies adding Bitcoin to their treasuries. While acknowledging the M2 correlation isn't perfect, he emphasizes the importance of considering multiple indicators and market trends for a comprehensive understanding. He points out the rising institutional interest and corporate treasuries accumulating Bitcoin alongside increasing global liquidity paint a bullish picture. This information should not be considered as financial advice. Lark Davis raises some thought-provoking points. The correlation between M2 supply and Bitcoin price has been a hot topic, and his video adds to the conversation. The involvement of institutional investors is indeed a significant factor, potentially signaling a long-term bullish trend for Bitcoin. Looking at recent news, BlackRock's Bitcoin ETF filing further supports this institutional adoption narrative, adding fuel to the bullish sentiment surrounding Bitcoin. It's an exciting time for the crypto market, and the interplay between traditional finance and digital assets is becoming increasingly intertwined. In the latest video from Ben Cowen's channel, he discusses his theory that all Bitcoin pairs will hit their range lows. He predicts a further 20% drop, even with unemployment rates recently decreasing and a potential delay in rate cuts. Ben anticipates this drop, despite some short-term bounces, especially given the labor market reports indicating low unemployment, 4.1%, might push inflation up and further delay accommodating monetary policies. He references previous market cycles to support his claim, pointing to June lows followed by rallies and then further drops into late October. He also compares altcoin performance against Bitcoin and USD valuations, arguing that while altcoins might appear to have performed better in USD, they are still bleeding against Bitcoin. He uses charts to demonstrate these patterns and points to a potential outcome similar to 2019, where a small summer bounce was followed by a significant drop to range lows by August/September. His ultimate target for all Bitcoin pairs is 0.25. He mentions 0.31 as current value, and also includes stablecoin USDC in his analysis, placing it at 0.29. Finally, he mentions total 3 market cap, excluding stablecoins, in the context of lows from the last cycle, 0.21 against the current position of 0.28. I find it very interesting that Ben Cowen makes this prediction, despite the fact that other macro indicators have also been relatively bullish for Bitcoin recently. There has been talk of multiple spot Bitcoin ETF applications being approved, and BlackRock has even applied to launch one. The halving event for Bitcoin is slated for next year as well. Despite this, Cowen's predictions for altcoins usually come to pass, so this will be interesting to see. In the latest video from Coin Bureau, Guy talks about the fourth turning, a historical cycle of societal crisis. He explains this cycle and its 4 phases: high, awakening, unraveling, and crisis, citing the American Revolution, Civil War, and the Great Depression/World War II as examples. He says we are currently in a fourth turning due to economic imbalances, huge global debt, political fragmentation, China's rise, and a generational shift. He predicts market volatility and suggests diversifying into tangible assets like infrastructure, defense, commodities, and real-world crypto projects, possibly as soon as 2027. I find the fourth turning theory interesting, and it does seem like many of the factors mentioned in the video are playing out. The amount of global debt is truly staggering, and political division is rampant. I don't think it's all doom and gloom, though. History shows that periods of crisis can also lead to innovation and positive change. Looking at the rise of renewable energy technologies in response to the climate crisis is one current example, though this is one interpretation. Regardless of how events ultimately shape up, it's important to stay informed and adapt. In the latest video from Crypto's Russ, the U.S. House passed a controversial bill impacting Bitcoin in the crypto market. The bill, which increases the U.S. deficit, didn't include the rumored capital gains tax elimination on Bitcoin transactions. This increased deficit could lead to more dollar printing, potentially driving investors towards Bitcoin. The video mentions Bitcoin's price nearing $1,100 and predicts further growth. 3 additional crypto-related bills are awaiting votes: the Genius Act, Clarity Act, and an anti-CBDC Act. The video also discusses new Bitcoin ETFs, including a potential Aptos ETF following Aptos' launch of Shelby, a high-performance decentralized storage solution. It's interesting how this bill, while seemingly negative due to increased deficit, is being spun as a potential positive for Bitcoin. The logic presented in the video, increased deficit leading to more dollar printing, thus making Bitcoin more attractive, is a common narrative in the crypto space. Recent news articles about the bill highlight concerns about its impact on the national debt, which could add fuel to this narrative. However, it is also being debated if Bitcoin is really unaffected by the general monetary policy, as some articles suggest the Fed rate increases could have impacted the last bearish cycle of Bitcoin. It's a complex issue with multiple perspectives and competing narratives. In the latest video from Crypto Banter, Ellen Dro discusses 2 major upgrades coming to Hyperliquid and L1 blockchain with an on-chain central limit order book. The first, Tip 3, lets anyone create a perpetual market by staking 1 million HYPE tokens, currently around $38 million, and managing the market. This decentralizes listing choices and could attract significant volume from retail futures traders. Alejandro uses the example of a potential S&P 500/QQQ index market capturing 5% of the $13 billion daily retail futures volume, generating $118 million in revenue for both the market creator and Hyperliquid. The second upgrade, Core Writer, acts as a bridge between Hyperliquid's L1 and its EVM sidechain, allowing for interaction between the two. This enables new DeFi applications, such as borrowing against L1 positions, and could attract more liquidity and developers to the ecosystem. Both upgrades are designed to increase the utility and adoption of the Hype token. Alejandro highlights that the combined liquidity on L1 and EVM sidechain currently exceeds $1.8 billion, suggesting significant growth potential with these new developments. The idea of decentralized perpetual markets is exciting, and Hyperliquid's approach with HIP-3 is novel. However, the high staking requirement could limit participation. The success of this upgrade hinges on whether projects can create compelling markets and attract sufficient trading volume. The Core Writer upgrade seems promising for DeFi innovation, but it remains to be seen what kind of applications developers will build. While the combined current liquidity of $1.8 billion is an impressive statistic, the overall value locked could fluctuate greatly considering the crypto market's volatility.